Besides the question, do I have enough to retire? Do you guys want to know what the most common concern is for someone retiring before 65? Like I'm talking well before 65, maybe even like 50 years old, maybe even late 40s. If you're watching today's video, you probably already guessed it. It's health insurance. Paying for health insurance is one of the biggest factors for people delaying retirement until 65. But the reality is that most people don't even understand what their health insurance are. So today we're breaking down what your three main choices for health insurance are prior to 65 if you retire early. I promise you don't want to miss it. Welcome back, guys. Be sure to hit that like and subscribe button if you like today's content. And of course, if you need help with your own retirement plan, financial plan, tax plan, whatever it may be, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. All right, guys, let's dive into it. Your first option is COBRA. As long as you work for a company that has at least 20 employees, you will have the option to continue paying for your current health insurance plan. How it works is upon separating from your employer, you will have 60 days to make a COBRA election. If you make the election, you can stay on your current plan for up to 18 months. Now, COBRA, to a lot of people, when they first learn about it, I would say that this is the option a lot of retirees gravitate to. In fact, I've seen a lot of people retire and just choose to utilize COBRA because they think, well, that's what everyone does, right? While it sounds really good on the surface, the issue is that you are responsible for paying the full premium associated with that plan. So let's say that your plan costs $10,000 a year and your employer was covering 70% of the costs. Well, now you're going to be on the hook for the full $10,000. Plus you can be charged up to a 2% administration fee. Now that's pretty damn expensive, especially when you factor in the fact that in 2024, the average premium for a family health insurance plan in the United States was $25,572. Because of this, if you are someone looking to retire early, usually this isn't going to be the best option because it only provides you 18 months of coverage and it's incredibly expensive. Now, there are cases, however, where electing to utilize COBRA can actually make sense. And that's usually when you're retiring, let's say at 63 and a half, and you need to bridge that gap between then and when Medicare starts. In addition to this, ideally you have an HSA. If you've been good about saving into your HSA and investing those funds, a lot of folks don't realize that HSAs can actually be used to pay for health insurance premiums associated with COBRA. Usually you can't use an HSA to pay for health insurance premiums. However, COBRA is an exception. So if COBRA doesn't sound like it will work for you, then you could potentially go with a private health insurance plan. Typically, these plans are short-term in nature and are going to vary from state to state. So for example, if you have a plan that is good for 12 months of coverage and then you need to renew, the benefit of getting a private health insurance plan is that it can be a lot cheaper than utilizing COBRA or going through the ACA, which we'll talk about in a moment. The issue with these plans is that they can exclude coverage for pre-existing conditions. That's unlike an ACA plan or your employer's plan. They also have limited preventative healthcare coverage and are missing a lot of the other core features that a traditional health insurance plan may have. Despite all of that, they can be a better deal, especially if you're someone who doesn't qualify for ACA subsidies, but you need to see if that plan fits your personal healthcare needs. That's why I always recommend that you utilize a health insurance broker when you're trying to pick these plans. Don't just try and piecemeal it yourself. Finally, let's talk about option number 3, and that is the Affordable Care Act Marketplace, or the ACA. ACA health insurance, also nicknamed Obamacare since the ACA was created under the Obama administration, allows you to get health insurance coverage and shop plans from insurers like Anthem Health and United Healthcare. There are 4 levels of plans on the marketplace based on the split healthcare costs between the plan and the individual. So for example, bronze plans are going to typically have very low monthly premiums. but you're going to pay more out of pocket for healthcare costs. Whereas a platinum plan, which is the highest level plan, is going to have the highest monthly premium, but provide you with the lowest out of pocket costs. Now, unlike private health insurance plans, plans on the ACA must give you coverage for pre-existing conditions. They must also provide essential health insurance features like covering prescriptions and lab coverage. You are also guaranteed to be renewed for coverage on an ACA plan, and there are limits on how much out-of-pocket costs you can incur. Now, because these plans have mandated features associated with them that you're probably more familiar with since you've had an employer-sponsored based plan, they're going to be more expensive, which is why a lot of people get really bad sticker shock when they transition from retirement to getting an ACA plan because they see how much those premiums are. Now, one huge benefit with the ACA that you could take advantage of that you can't do with COBRA or a private health insurance plan is take advantage of premium tax credits. If your income is between 100% and 400% of the federal poverty level, and there's a whole formula to determine this based off the type of income that you have and your household size, you will likely qualify for a tax subsidy that will reduce the cost of your health insurance. So really quick, let's take a look at an example. So you're looking at a couple who is 55. They are both retired early, but they have some part-time self-employment income coming in, and they are just simply taking straight distributions out of their pre-tax retirement accounts to supplement their living expenses. And as a result, their household income is $250,000. In this example, you're going to see that they don't qualify for any premium tax credits, and their monthly insurance costs, assuming they went with a silver plan, would be roughly $1,733 a month. That's obviously extremely pricey. I mean, we're talking almost $21,000 a year just for health insurance premiums alone. However, let's say that they were a little bit more strategic from a tax and retirement planning standpoint, and they were able to drive their household income down to $60,000 a year. Now you're going to notice their monthly premiums are $287 a month, or $3,444 annually. Now, not only are we saving a ton in taxes, but we're also saving a ton in health insurance costs as well. Now, you're probably wondering, how does someone actually drive their income that low to not only reduce taxes, but to get this massive healthcare subsidy that reduced their healthcare costs so much? Right? These savings can go on for years and years and years and really compound on themselves. Well, that's where really strategic portfolio design matters. That's where really good tax planning in retirement matters. That's where being strategic about where you're drawing from in your accounts. That's where being strategic with even strategies like buy, borrow, die, right? Isn't that crazy? They thought of borrowing against your portfolio to potentially reduce your income so that you can take advantage of these type of strategies. All of this stuff matters big time, and that's how you're able to do that. In our next video, we're going to be covering a case study that breaks down exactly how that happens. So be sure to like and subscribe so that you don't miss that case study. So there you have it, guys. Those are your 3 primary health insurance options you can utilize if you chose to retire before 65. If you need help creating a retirement plan that game plans for health insurance and the very issues we discussed today, reach out to us at www.modernwealth.com. That's modern, spelled with no vowels, wealth.com. I'll see you next time, guys.